Welcome to the CFO Track podcast, where we inspire and educate future finance leaders to help them stay on track to CFO. I'm your host, Tom Hunter, and every week I'll be bringing you stories from some of Australia's best and brightest CFOs and the lessons they learnt along the way. My goal for the podcast is to provide learning and development opportunities for those wanting to get to the level of the guests on this show, but they just didn't have the access to those lessons otherwise. Let's get into it.
This week, I'm speaking with Steve Abbott. Steve's the CFO of Waste Services Group, a PE-backed environmental services business. Steve gives fantastic advice about how to build out a mentoring program and then how to push a career into a more operational or commercial direction. He also gives an interesting perspective about what finance looks like in an AFL setting after spending some time with St Kilda Football Club. I know there'll be lots of fans out there for this one, so here we go. Steve Abbott, welcome to the CFO Track podcast.
Thanks, Tom.
How are you going? How's the week been?
Yeah, it's been good. It's been busy. We're back from Christmas and plenty going on.
Yeah, nice. Is this time of the year flat out for you, or is it a bit of a cruisier time?
It's all pretty flat out.
Yeah.
Private equity owned businesses tend to run at a certain pace. So, we're certainly 100%
Yeah, nice.
released and we'll continue like that.
Yeah, very good. Very good. So I've already given the listeners a bit of an intro already, but I can never do it justice. So it'd be good to hear from yourself, what you're working on in the minute, where you're at, a bit of a bird's eye view.
Sure. So I'm at the moment, the CFO of Waste Services Group. I've been here for about 3 years. It's a business that runs, that sort of looks after a bunch of different businesses in the waste and recycling sector. It's probably consistent with a lot of my history in that it's a reasonably big business that nobody's heard of. I'm sort of covering all the usual finance areas, the accounting, treasury, the tax and IT and data and insights. So yeah, it's a busy time.
Nice one. So I think that the whole idea behind the podcast is to give up and coming finance professionals that access to L&D opportunities. So it'd be good to go back to the start. So what was it about accounting? What was it about finance? What drew you to the industry?
It's fair to say that when I, made the decision, which is probably before I went to uni, I didn't have a great plan, which is consistent with a lot of 17, 18-year-olds.
Yeah.
This was sort of the sort of late 80s. The Australian economy was flying, the deregulated, the currency, there was substantial GDP growth and people going into commerce broadly, accounting, finance, economics, were really stepping out of their degrees and straight into really good roles, whether they were with big four accounting firms or with a bunch of other different employers. So without that clear vision, it just seemed like a good place to start. So it did reasonably well at school, got into Melbourne Uni Commerce. And I did the degree, stayed fairly broad with accounting, finance, economics. And I actually went and did a postgrad and I was working part-time as an economist, actually. And I got involved in a project which was supporting the deregulation of the Australian energy industry. And that probably set me on a path, probably for the next 10 years, where I ultimately, after being involved in that project, I went and worked in the energy industry as an accountant, but also as an analyst and also as an energy trader ultimately.
Yeah, right.
Which was a really interesting time because it was all new. So we had the industry. There were new markets, there were new businesses, there were new roles. There was not somebody who had been in the role for 20 years. We were sort of making it up a bit as we went, which was really, really good.
Yeah. What was the trading stuff like? That sounds fun.
Yeah. Well, as I said, it was all new. It was really an interesting time because there was no blueprint on what to do. There were two types of people involved in that in the 90s. There were people that were like me that had come through probably more analytical or accounting backgrounds and, just sort of found their way into it. And then there were a bunch of people who had come out of really the currency trading environment, which in the 90s, which was pretty crazy, pretty wild. And because of the automation of that process had moved across into energy because it was still not automated. So
Yeah.
we had a bunch of people like me, and then you had a bunch of sort of 1980s currency traders, who were used to squawk boxes and,
Yeah.
it was a lot of fun.
Yeah. Yeah.
I will say that.
Yeah.
But it was pretty eye-opening as well.
Yeah, for sure. How long did you do that for?
It was probably 2 or 3 years. And look, what I really took out of it was, when you start out in a role at a junior level, you're predominantly focused on tasks. And then as you sort of move your way through, you're getting into more and more decision-making type roles.
Yeah, okay.
As a trader, you have to make decisions every day. You don't get a choice. And so what I took out of it was, get a bunch of information, analyze it as much as you can, work out what the risks are, talk to other people, and then go and execute. And that's something that, I think sort of I took away from that role and, have sort of applied it through the rest of my career.
Yeah.
It just made me good at making decisions.
Yep.
I think, it probably wasn't a forever thing for me, but it was a good thing to have done.
Yeah. Yeah, nice. Well, and so at what point did you start thinking about what was next?
I think the natural training it's very much the same thing, each day, you're dealing with the market might change, but everything else pretty much stays the same. And I wanted to probably more move back into accounting and wanted to find a route to do that at that time, because there wasn't a huge history of this energy. I had a skill set that was attractive to the prospective employers, and that's ultimately when I went to Alcoa.
Yeah, nice. And so what was the role at Alcoa at the time?
Well, I started off as the energy manager, but I soon sort of morphed into running the whole of the commercial operations for the East Coast of Alcoa. Alcoa was great. Like, they put me through, like, it was really, I think, so just stepping back a second, I think it's really good to have a period in your career when you've done a really deep understanding of, the accounting requirement. A lot of people obviously go through Big Four accounting and through an audit, and that's their sort of foundation. For me, it was Alcoa. Like, Alcoa was established with IFRS, reporting, US GAAP reporting, treasury requirements, financial close. And I got an opportunity to sort of work through all that and ultimately ran the accounting function for those East Coast operations. And so I think that was a really strong foundation piece for me. And it also sort of, I managed to, get involved in other areas as well, sort of more commercial.
Yeah.
Which I really enjoy,
So when did the joint venture come into it? Because that was at Alcoa, right?
Yes. Alcoa, one of Alcoa's assets was actually as part of a joint venture, the Portland smelter.
Yeah.
There were 3 partners on the joint venture. I sat on the joint venture for maybe 3 years. It was Alcoa, who was also, the sort of global aluminium giant, which is the one company I work for. There was Marubeni, and there was also CITIC.
Yeah, okay.
Marubeni being a giant, really Japanese trading business and also asset owner, and CITIC being a big Chinese conglomerate.
Yeah, okay. So they're very different business cultures. So how did you navigate that?
I think first of all, to acknowledge they're different, right? So Alcoa's US based, so everything's very clear, and then there's a degree of sort of demanding element to it. I mean, there were quarterly information that has to go to the stock market, and that drove a lot of the focus for Alcoa. Obviously looking at long term, but also what are the quarterly numbers, analysts' calls and things like that, which I, would listen into. Dick Marubeni, totally different structure. CITIC, a Chinese conglomerate, really very, also quite fast paced. Really always wanting to get more information, more knowledge. I found them both really good to work for. I think Marubeni was different. They were slower in terms of their decision making processes. They were very thorough.
Yeah.
They were very respectful.
Yeah.
Ultimately, to be able to get a decision of a joint venture, parties need to be happy.
Yeah.
So, so it was really about trying to move everyone along. And we were the manager, so we were sort of driving a lot of the decisions. It was about moving everybody along at their respective speeds to make sure that we could ultimately make decisions.
Yeah.
And that's probably what I learned from the joint venture is everyone makes decisions differently, and you've just got to understand and then make sure you can satisfy their requirement.
Was there any particular times where that was especially challenging? Because I could imagine in selling high stakes like that, it gets troublesome.
I think it became better over time.
Yeah.
And that, and probably that was just about trust, and when people, you've spent more time with people and they understand you, and particularly in the Japanese side, they ultimately got very comfortable, and then they were happy, they're happy to support recommendations that the manager would have. So I think that was probably the main learning is just building credibility with partners over time.
Yeah.
Is really important.
Yeah. And so additionally, what do you think you took from that as a result of managing stakeholders internally or externally going forward as a result?
I think probably just listening,
Yeah.
maybe more than talking sometimes. And also doing the groundwork before you ask for a decision. So understanding that there were a number of steps that we would need to take to be able to make a decision. And so I would have maybe a one-on-one meeting with Marabini before we went in, and they given the opportunity to ask any additional questions. But by the time we got to the decision-making point, their questions were satisfied. They'd spoken with Tokyo, everything was fine. It had the same requirements. So that's probably what I took out of it.
Yeah, nice. So how long were you there for at Alcoa?
I was there for 8 years.
Yeah.
Really, really great. I mean, the other thing about Alcoa is they've sent me all around the world.
Cool.
Got to work on a lot of cross-functional teams, a lot of sort of different geographies, teams of different geographies, spent a lot of time in the US, and, probably embedded what good looks like for me, which, ultimately is a foundation, I guess.
Yeah, nice. And so how did you said you moved a little bit around the globe? Was the role changing at all through that time? Does your day-to-day change at all different locations?
Not so much. With Alcoa, what they would do is they would just pull you out for a period of time and send you off to do something.
Okay.
So it was that type of organisation. It was you might go and be in New York for a month. I was in New York for a month with a bunch of people who had energy backgrounds and they wanted us to work on what was going to be the energy strategy for the business for the next 30 years.
Yep.
That was kind of the nature of the way Alcoa did business. And they had a really strong mentoring, sort of unofficial mentoring culture as well.
Yeah. Okay.
Which had sort of been developed over time, which I thought was
nice. And then so what led up to the move onto Fenner Dunlop?
So I think what I've done through that time is I've developed these skills and capabilities. I needed to go and I've been there for 8 years. I needed a change. And I think the opportunity to take that CFO role, I'd done a lot of the groundwork. To enable me, as I said, I've been through the audits process, I've done tax, I've done treasury, I've done those things. So it was a sort of a natural step. That said, I think when I moved into the role, I thought I was ready to go, ready for it. But I also had responsibility for managing 3 manufacturing facilities, which I had some exposure to.
Yeah.
To facilities and how they worked.
Yeah.
But I wasn't running them. So that was a massive challenge as part of that step across into Fenner.
Yeah. So how was the first CFO role for you? What was it like coming into it first few months?
It was a challenge. Like Fenner, just a background, it was a FTSE 250, a FTSE 200 company, so a reasonable size. Its structure is a bit like a Wesfarmers. It's a conglomerate. The centre's really mostly focused on capital allocations, and the businesses run themselves to some degree. That said, I was lucky. I was mentored by a really experienced CFO in Richard Perry out of the UK, who had been the sort of CFO of the year on the FTSE and things like that. So that was good. Yeah, the biggest challenges I think were I wasn't 40 at that stage, and I think I thought I had to act like a CFO.
Yeah.
which is, and I was probably a bit standoffish with people.
Okay.
And probably if I reflect back, I probably could have been just myself.
What does too serious mean though? Like, what is that looking like in the day to
I
day?
didn't invest enough time in probably the relationship side of
Yeah.
things. I think I looked at it more as I've got a bunch of decisions that I've got to make, and it wasn't, and I was still, as I said, still relatively young,
Yeah.
and managing manufacturing facilities, so I just didn't engage enough through that.
Yeah.
Um,
Okay. Yeah. How would you change it if you were to go back again and do it?
I think it's just more probably just being myself.
Mm.
I think, you want to take your work super seriously, but you don't always want to take yourself super seriously. So, you want to be able to have fun with people,
Yep.
and have a good connection with them. So I probably just would have been more relaxed on that side of things.
Yeah.
But, ultimately, I mean, I think the other thing that I probably reflect on in that role, which was actually probably a benefit, was, it's a cyclical business. It's supporting the mining industry. So, it did teach me a lot about, ramping for growth and then decelerating for periods when things weren't as good, because that's what
Right.
cyclical businesses do.
Yeah.
And in some respects, actually, getting the resource allocation right for
Mm.
the growth side is actually more difficult than on the way down. I mean, the
Yeah.
way down is difficult because you're dealing with people and it's complicated,
Yeah.
in terms of downsizing, things like that. But you sort of don't have choices. You know what you have to do. Where on the upside, you're really looking at it and going, should we invest in that new capital equipment? Should we put on another 50 people? And what happens if in 6 months' time
Yeah.
the global price of iron ore and coal goes down and the customer's demand falls away?
Yeah.
So, that was an interesting time.
Yeah. How do you do that accurately then?
What you can't lose track of is the fact that you are in a cyclical business,
Mm.
right? When you're going well and it's going up, the expectation, and you see it in budgets and forecasts everywhere, is it's just going to keep climbing, keep climbing. Cyclical businesses, they want to grow through the cycle, but there'll be periods in the cycle where revenue declines.
Yep.
But and that's the same with all the miners. That's, when the price goes down, revenue goes down.
Yep.
So, um,
Yeah.
that's what I learned from it.
Yeah. Nice. And so your role seemed quite commercial at the time. It seemed pretty operationally. So you moved through a couple of roles there at Fenner?
Yeah. So after 5 years, I moved from the CFO role into a COO role,
Right.
which was, very different. I went to sort of, I did that for about 7 years,
Mm.
had like 800 people working for me, a bunch of different, operational, trades, engineers. And it was, when you've got 800 people working on different sites around Australia, safety becomes a really big issue, and you spend a
Mm.
lot of your time on people management as well. That really orientated me in a totally different direction. That was probably when, I was saying before about being a bit standoffish. I went totally the other way.
Yeah.
I'd had good mentors who were really good people managers,
Yeah. Okay.
Alan Kransberg at Alcoa and Dave Langford at Fenner. And I sort of totally embraced that. Spent a lot of time in the field, in mining environments, out in the middle of nowhere with operating teams,
Mm.
telling them about, what was going on in the business, but also listening to what they had to say. Developed a lot of really good relationships through that, and really enjoyed my time. I was the director of response for safety, and that was a massive part of that work.
Yeah.
I think what I took out of it was, the when you're a CFO, you look at the world a particular way.
Mm.
And when you're a business owner, or somebody who's responsible for operations, you're not just looking at the financial, you're looking at
Mm.
the people side, you're looking at the customer side, you're looking at all these other perspectives. I think that 7 years ultimately made me a lot better CFO because I got a different perspective on things.
Yeah.
You walk in someone's shoes, it just means you make better decisions. And I think the other thing is I sort of had worked that out as part of when I started off as CFO, was that the accounting side just makes up a really small part of what it
Yeah.
means to be a CFO. Like, when you look at resource allocation, capital allocation, pricing, legal requirements, governance, technology, accounting squeezes in there, and you certainly need to know and you need to understand, that you need to be involved in those discussions, the audit and
Yeah.
the like. But a lot of the CFO role is different to what it is, say, being a financial accountant.
For sure. So, because your career is naturally being quite commercial and operational anyway, but there'd be lots of people out there that are stuck in the numbers and wanting to get out into the business. How would you recommend they go about that, and what's, I guess, a step-by-step approach?
Yeah, I think, I think first of all, ask for the opportunity,
Yeah.
right? Because I don't think it will come to you unless you ask for it. So, and particularly if you were somebody in their, say somebody in their 30s, you need to try and maybe migrate in from a purely financial role into a commercial role. I think some of those organisations of a certain size allow you to do that.
Yeah.
And then when you do that, make sure that you have access to people who can help you with that, that move, because it's different,
Yep.
in terms of the way you think about things. A finance person is predominantly focused on whether things are right, correct?
Mm.
And a commercial person is focused on whether things are of value.
Yeah.
So you've got to help someone, you've got to find someone who can help you make that transition in terms of looking at the business through a different set of eyes.
Yeah. Yeah. And was it around that point when you started the mentoring program as well? I think that was something you did at Fenner.
Yeah. Well, as I said, I had that exposure at Alcoa, so I sort of knew what good looked like. A lot of my time at Alcoa was foundational in terms of from the accounting perspective, but also in terms of the people development. Alcoa helped give me that foundation. So when I moved into the COO role, I had 5 or 6 people, a number of which were in their early 30s as general managers. They were really good at what they do, but they were young and still relatively inexperienced. So it was the right opportunity to really bring a mentoring program in, which I did. And I think back about that, and it was quite structured. But I think back about that, and what I really, I guess, a couple of reflections is those people got a lot out of it.
Yeah.
Just that I'd done, what it meant that was that things that might have taken them 5 years to learn by making a few mistakes along the way, they could sort of learn in 1 year. And through a structured mentoring program that allowed them just to leverage the experience of others.
Yep.
So that was good. They got a lot out of it, which was great. The second one was they've all gone on to bigger and better things, which is great. So one's a CEO, one's doing my old role as a COO. They've really, sort of blossomed into, they got the benefit of that. And the final one's probably, I just got a lot of personal satisfaction out of it. I'm probably most, traditionally motivated by the result. What is how are we going? Are we improving, from a profitability perspective? Are we improving from a safety perspective? But I actually got personal satisfaction out of seeing those people do well as a consequence of that. And I had another role as part of the process is just, I was the managing director of the registered training organisation that we had in the business as well. And, that was more on the trade side rather than the sort of leadership development. But just got a lot out of seeing people go through that program, including the supervisor's course, because that's a big gap around every environment that I've worked in is teaching people that first level supervision. They got a lot of benefit out. I used to go up there and close the events with them and go out and have, food, drink, and have a good time. And it was great to see them really getting benefit out of it as well.
Yeah. So was that a structured program that was already there prior to you getting involved, or is that something you started to build incrementally?
The registered training organisation?
So the mentoring program?
Oh, no, the mentoring program I started from scratch. I brought in people who could help me with it, who were established people. It was something that sort of grew organically.
Okay. So how do you start that then? Is it something that just starts really loosely and it's kind of like soft catch-ups, or did you go hard early and try and create something structured that the business got involved in?
It was different depending upon the circumstance.
Okay. Yep.
So for example, when I first started it, it was quite structured in the sense that the first one I did, I actually brought in somebody from external.
Okay.
We three would set clear guidelines on what we're trying to achieve. It was really driven by the individual who was being mentored, what they wanted. And in that situation, the mentoring was being done by the external party.
Yeah.
But I would catch up with them every couple of months and just give feedback on how the individual was changing or growing as a consequence. So there was sort of like a feedback loop. And, that might go for 12 months. And I'd say those are the three things that we agreed on. This is what I've observed in terms of these two areas. This one's probably needs a bit of work.
Yep.
And then as I sort of got more familiar and had a particular preferred approach, I could just do that myself.
Yeah.
So I could have that conversation with people.
Yep. So did you need to get a level of investment from the business to be able to do it in that structured way? Like how did you position that to get that from them?
I didn't really have to. I mean, I was CFO, that helped. So, in terms of the financial commitment, it wasn't a huge commitment.
Yeah,
the main commitment is time, right? The
Sure.
main commitment in this situation is making sure that the mentor is prepared to commit the time.
Yeah.
And that's probably I'd say a broader industry thing.
Yeah.
In that, I'm sure there are pockets of people doing this really well, but time's a pretty important commodity. If you want to be a good mentor, you're probably looking at committing, on average, probably at least 1 hour a week to the person being mentored. On average, I would say, not on every week.
For sure. And it's such an industry-wide problem and part of the reason why I decided to do this, right? So if someone is trying to build something similar in a smaller organization without the access to the resources or et cetera, how would you recommend going about it?
Well, I would, if you don't know anything about it and you haven't had exposure to it, I would find the right person.
Yeah.
In first instance to become a mentor for one person. So rather than have this big program, just do it with one person. There are plenty of people out there that do this. And being mentors for and it'll cost some money, but that I think is the test case.
Yeah.
If you've got one person, and particularly make sure you find that the mentee has to really buy in. Yeah. Otherwise, it's a complete waste of time.
Definitely.
So they're probably the two things. Do it once, see whether it works or not, how it works, understand it, and then you can adapt it from there.
Yeah, nice. And so you're at Fenner for about 11, 12 years in the end, and that sort of came to a conclusion. And you keen to hear about this one. You spent some time at St Kilda Footy Club? Yeah,
so 30 years of work, and this is the 6 months that people always really want to ask about. Who would have thought that aluminium smelting and conveyors weren't that interesting? But the finished, like a 12 years, was great. I loved it. I was sort of just working out what I wanted to do next. I had a phone call. I'd only been out of the role for a couple of weeks over holidays. Yes, St Kilda wanted a CFO to come in and just help out with the transition period. So I wasn't really itching to, my background's all sort of industrial services and manufacturing. It wasn't, I hadn't even thought about going into sport, but I was a fan and I thought I'll go and do it for 6 months. Are you
a St Kilda fan?
No, I'm not. But a lot of people that work in football clubs aren't actually fans of the club. They just like working in the environment.
And it probably helps you to separate it as well, because if you're emotionally involved, then your decision making's a little bit impacted as well.
I mean, it's. I think you become emotionally involved in football, in the football club anyway. I was certainly keen to see St Kilda win.
Sure.
But it's business, right? Hey,
it's good for business if they win.
It's good for business. Good for more people coming to the games and more sponsorships and things like that.
Yeah.
But I think what I learned really was, the main thing about football clubs is winning games of football.
Yeah.
Right?
Yeah.
They're also incredibly involved in social programs because they've got profile. Their commitment to mental health, in St Kilda and a number of other programs.
Yeah.
And then go down a couple of runs and you eventually get to sort of the commercial financial stuff. Yeah. Where in a business, your primary focus is obviously being successful financially, making profit and making good cash flow as a return on investment, those sorts of things.
Yeah.
So it's a totally different way of thinking.
Yeah.
And, when you look at the way the AFL operates, the entity that's really involved in the business of football is the AFL.
Yeah.
They do the broadcast deal, which generates a lot of revenue. They do the AFLPA negotiations for the players. They do the fixtures. They're sort of the overarching structure. Sure. And then underneath that, the clubs there to obviously be financial, but their primary focus is to win games of football.
Sure.
So it's very different from a business perspective.
Yeah, gotcha.
Enjoyed my time there. Really great to get an internal understanding of how the AFL works.
Yep.
But then was keen to move back into
sure.
normal business.
So you were there towards the back end of the year. Did they pull you into any free agency or trade discussions?
Well, you've got oversight of the salary cap, right?
Yes.
So there's an element of saying, no, you don't have enough money to spend on that player. But they understand that. Like the people that are list managers and people that are in charge of that area understand that there's a constraint, and that's pretty well understood. It's different, that's for sure.
Yeah. So short and sharp, and then finish up your time there, and then moved on to waste services. So
that's right. Yeah, 2023, I moved across in a private equity owned business, which has been really good. I've been there for coming up on 3 years. So it's a substantial change. Private equity. It probably suits that strategic execution that I was talking about before, because everything is very clear about what you're trying to achieve. Double the size of the business in 3 or 4 years. The shareholders are going to be there for a finite time. It is pretty intense. A lot of M&A. So I've done some M&A acquisitions at Fenner. But then in the last 2.5 years, we've done 10 acquisitions. And then post acquisition implementation. But there's a lot of that's intense periods.
So it's about one every few months.
Yeah, pretty much.
Right.
So it's almost like a division of the business.
Okay.
The way you need to think about it. And the big part of that is really, obviously you go from, discussing with the shareholders of those acquired businesses through the process of due diligence, which is a big undertaking, and then finalising the contracts, and then post acquisition implementation, which is really important. I think I've learned a lot through that around particularly management of vendors, of founders and vendors who have been a big part of the generation of the value of the business that you're acquiring. And what's their motivation after they sell? A lot of them have already ordered the boat. They're going to buy. How interested are they when they're not the primary shareholder of the business? But they can also be a big driver of the sort of goodwill of the business, right? They can own a lot of the customer relationships, relationships with staff. So post acquisition implementation doesn't just go to systems and processes, it also goes to how is this business going to operate in an environment once the founder is less involved.
Sure.
So, I've been doing, the first one I did was in 2010. So I've probably learned a bit about how that works, good and bad.
Has your approach changed as a result of so many?
Yeah, I think doing more of the thinking up the front of the process as part of the due diligence, not so much just on the technical process things, but more on, does this business have a really good 2IC? Who is going to naturally move in to run the business when the founder moves out?
Right.
What does that transition look like? Does the founder agree with that? All that stuff needs to be discussed up front. Because if you don't do it early, then it becomes this issue after you've acquired the business.
Yeah, sure. And so that process of the 10 or so that you've done in the last couple of years, what was something that through that period you didn't anticipate, or something to come up that was a surprise?
Well, I think probably we moved into one business, which was, a paper recycling business. And probably the thing that I didn't sort of realize at the time was, the paper itself is not all the same.
Sure.
Like I just it was commodity in, commodity out. But the reality is different qualities of input through a recycling facility means different outputs. So we've done the due diligence on that. But I think only until after we got involved in the business a bit more did we understand the margins were different and the opportunities were different. So that was a different style of business to sort of some of the other acquisitions which were more core to what we previously we'd been doing already. So probably and it all goes back to how much you do at the front. Right? You just got to do the work at the front end of the process.
And it sounds pretty intense. So how did you manage that alongside your day-to-day and life?
Yeah. Well, as I said, we've got to, I think in terms of intensity, we've got a structure within the business that is so used to doing that every part of the business sort of knows what they need to do to enable the transition.
Yeah.
I think probably the biggest, most intense period was actually the sale process of our business in 2024.
Right.
And that pretty much took the whole year.
Yeah.
It's, the sale of the majority interest in equity interest from Living Bridge to Carlisle Group.
Right.
And, I met with maybe 30 different groups, myself and the CEO. We would almost know what each of us were going to say.
Yeah.
Before we said it. It was about 80 hours of presentations.
Jeez.
Then substantial due diligence where you're servicing the actual potential buyers, of which there were a number. And then, obviously then through the sale process and post-sale processes. That's a full-time job.
Yeah.
But business continues to operate.
Yeah.
So you've got like a day job and you've got a night job.
Yeah.
And I think that's certainly an intensity that I hadn't worked at before.
For sure.
And so, I enjoyed this, but it's full on.
For sure. Because it's obviously a great business and career challenge, but how do you manage personal or family life alongside that?
Well, it's funny. So, because I spoke to, I spoke to Kevin O'Sullivan, who you've had on the show. Kevin went through this before, and he said, "Steve, just have dinner with your family before it starts.
Yeah,
wave to them, and say you'll see them in about 10 months' time. It's not quite as bad as all that, but it is 60 hours a week.
Right.
For 10 months.
60 hours a week on top of the
in total.
Yeah.
So it's an intense time.
Yeah. Okay. Would you do it again?
Yeah.
Okay,
I really enjoyed it.
Yeah.
It's just, I probably would have set up a few things in terms of the day-to-day operations of the business where I probably would have just delegated more things.
Yeah, right.
So that the business could continue to operate and I could focus on the sale process.
Yeah. Nice.
Which was really important to obviously all parties. So
No,
I enjoy PE. I enjoy the fact that you make decisions quickly. Your strategic execution is the focus. Everyone's aligned, which is great. And you want to get a result.
Yeah.
Which is
for sure. And so where's the business at the minute? What does the next few years look like?
So more of the same. It's been pretty successful. So we'll continue to sort of follow the same strategic direction that we're doing. Ultimately, there'll be an exit at some point in the future when the equity partners want to exit. That'll be at a time, hopefully, when the business is quite a substantial operation, which it already is, but it'll be a big business within Australia. Again, another one of these businesses that no one's heard of, but it actually is, sort of $1 billion plus business. So I think our business is well over $1 billion in terms of its underlying value. So,
yeah, right. Nice. And so what are you seeing as bigger challenges across the board from an industry perspective for the business specifically or accounting as a whole?
Well, I think the challenges for the broader waste and recycling industry is how do you put more material in through recycling for a bunch of different reasons. That's an ongoing challenge for Australia, and for environmental reasons, just for ultimately for resource availability of resources. And there are other jurisdictions that are doing that better in Europe and places. I think Australia's going to move up the curve a bit with that. And governments really will drive a lot of that in terms of the way the levers that they pull. And so I see that happening. You'll just end up with more bins is the way I'd say it. You've already probably got 2 or 3. You'll probably end up with 5. For finance, I guess, it's interesting because I think the easy answer to that is to say, well, make sure you're moving into an environment where you are adding value because some of the day-to-day accounting roles will become part of, will be AI and will be swallowed by that particular area. Make sure if you're a financial accountant, make sure that you get some exposure to commercial, whether it's more of a decision-making process.
Yeah. So do you think that's the area that will be seen as the most value add? I think
that it's more probably the pure financial might end up getting swallowed up by AI.
Yeah, okay.
That's a risk. That said, I was told that by a senior accountant about 20 years ago, and it hasn't fundamentally shifted in 20 years. So, I guess I'm probably sort of sitting on the fence a bit on that about when it'll actually happen. And if I say, if I'm saying, oh, maybe it won't happen, one day I'll be wrong. Yeah. So I just don't know when. So I would say that's probably a thing that the industry has to sort out. I mean, you're already seeing it in, financial due diligence is increasingly becoming sort of commoditized by AI. That's put pressure on that particular segment of Big Four firms.
Yeah.
And you can see the legal side of things going to be different in 5 years' time. Yeah, you got to make sure that you, if you're a young accountant coming through, that you get some exposure to areas where computers can't make the decisions.
Yeah. I think that's a tricky point. I think most businesses are still figuring that out altogether, to be honest.
Yeah, absolutely. I'm not talking about next year, but if you're looking at it from a career perspective, getting more involved in the people side of things is probably something that's of value, because that's not something necessarily that a computer can do.
No, that's right. Well, you've been great, Steve. I think your approach to both mentoring, stakeholder management, and the sale process has been really interesting. So I know the listeners will agree, but I hope they do as well. But if anyone has any questions or wants to reach out just to get your advice on anything, you're happy to field questions?
Sure.
Yeah.
No problem.
Where would be the best place to reach out?
Probably just come in through LinkedIn.
Yeah. Okay. Perfect.
Yeah.
Well, I'll put the links in all the when we go out, but appreciate your time and thanks for coming on the show.
Yeah, thanks, Tom. Thanks for having me.
Chat soon.
Thanks for listening to the CFO Track. If you enjoyed the show, don't forget to like, subscribe, and share with a friend. I'll see you next time.